let's discuss the valuation of futures and trying to determine how we could price one of these contracts. Okay, we got to understand the basic relationship between futures and the spot price of the underlying asset in order to be able to determine how we're going to price a futures contract. Okay, so if we're able to create a sort of artificial contract using assets that we know, and then find out what the price of that asset would be, we could associate that with the price of the futures and then find out the value of the futures through that. Okay, so the first example we could use is a T-bill future, okay, to try to understand how we're going to price a T-bill future. So assume there's an investor who wants to hold a 151-day T-bill future, a 151-day T-bill, okay? And basically the investor has two choices for how they can go about purchasing this 151-day T-bill. The first thing is they could just buy the T-bill directly at a cost P. That cost P would happen today. So you'd pay a price P and then obtain the T-bill and then find out whatever cash flows you get at the end of the 151 days. The second option would be to split it into two. Okay, you could first buy a forward that delivers a 91-day T-bill in 60 days, and you pay a price F in 60 days. Okay, so you're buying a forward on a 91-day T-bill for delivery in 60 days. Okay, and then today you could buy a 60-day T-bill that has a value F at the delivery date. Okay, so basically we're splitting that 151 days into a 91-day and a 60-day T-bill. Okay, we're getting a value F and sort of eliminating it at the 60th day. And then we're going to compare the two prices to be able to determine the price of a futures contract. Okay, so if the T-bill has a value F at the delivery date, that is the value in the future relative to today. So if we want to find out what it costs today, we're going to have to find the present value of that. Okay, the present value of that future price is just going to be whatever future value it had divided by some rate, okay, some interest rate, some growth rate. So what rate are we going to use? We're going to use R. Okay, R is the interest rate on the 60-day T-bill. Okay, so if you're finding the present value, that price of that bill today is F divided by 1 plus R. Okay, so this is how it would look in a timeline. Okay, we can buy a 151-day T-bill at price P0 at time 0. Okay, we get a $1 million cash flow at day 151. Okay, or you could do it in two steps, right? You could do it this way. You could buy a future and buy a forward contract and for delivery in 60 days of that 91-day T-bill. Okay, and you could buy a 60-day T-bill today. Okay, so if you buy the forward that leads to a delivery in 60 days of a 91-day T-bill, you're going to pay a value minus F in 60 days. Okay, what does that mean? That means that it's a cash outflow, right? You're paying out a value F, and at the same time you're buying the 60-day T-bill today that has a value F in 60 days. Okay, so the total intermediate cash flow is actually 0. Okay, because you got a value F, but you used that value F immediately to buy the 91-day T-bill. Okay, now this value F is valued today at a price of F divided by 1 plus R. Okay, the total amount of that you needed to pay today is F divided by 1 plus R. Okay, F divided by 1 plus R. If you notice, the final cash flow is still the same amount. Okay, it's still that same $1 million. Now, there's this law called the law of one price, okay, which states that two identical instruments should sell at the same price. Okay, if we've done something to cause both these instruments to have the same cash inflow or cash flow at the 151st day without anything else happening in the middle, they should have both cost the exact same amount at time 0. Okay, so we'll equate these two numbers. We'll equate P with F over 1 plus R. Again, we'd say that F over 1 plus R is equal to P. But we don't care about F over 1 plus R. We care about F. So if we wanted to find out what's the value of F, okay, we'd say that F equals P times 1 plus R. Okay, we just bring this term up to the top, okay, if we're trying to find the value of the future. Right. So basically, you need to know what's the law of one price. It just states that two identical instruments should sell at the same price. If there was a difference, okay, between these two prices, there could be a number of ways through which the prices equate, okay, and the textbook gives more details about it. Basically, there are people monitoring these relationships. If they notice any difference between the prices, they're going to step in and try to equate the price, okay, and that's called arbitraging any difference away. So the law of one price holds very closely. Let's look at stock index futures. Okay, stock index futures exist on a number of different indexes in the stock market. So we have like the New York Stock Exchange Composite, the S&P 500, the S&P 100, and so on. Okay, these are all evaluated indexes, and you can buy futures contracts on those indexes. Okay, so what prevented these stock index futures from existing back in the day? Okay, there was no way to transfer these assets over efficiently, and so once a cash settlement was introduced, these stock index futures came into play and be widely used. Okay, so how is this cash settlement happening? The futures marked to the spot. So the spot is the price at that day. Okay, the futures marked to the spot at the time the future expires. Okay, so whatever the price is on the maturity date, that's what it's marked against what the price was when you bought it, and then the cash is then transferred between the two parties who engage in this contract at that time. Okay, at the maturity date. So if you want to buy a stock index fund, okay, let's say you want to buy a stock index fund, again, you have two options. So basically, once again, in order to find the value of the futures, we're going to try to create two instruments that are the same. One that involves directly purchasing that fund or that instrument, one that involves something involving futures. Okay, and then we say, hey, the two prices should be the same if they give us the same outflow at the end. So we're going to equate the prices. Okay, so if you want to buy a stock index fund, you can first buy an index fund and eliminate any intermediate cash flows, because we do not want to have these intermediate cash flows affecting our understanding of the beginning and ending cash flows, right? We don't want anything else happening in the middle. So assume that P is the price of that index, okay? P is whatever price you paid for that index. P is in dollars, right? And the expected dividend amount from that fund is D. Okay, the expected dividend is D. Now, we're getting D at some time in the future. If we want to find out what's the value of those funds today, of that dividend today, we find the present value of it, right? So PV of D is the present value of the expected future dividends. Okay. Now, if we want to eliminate the intermediate cash flows, we're saying that, hey, we are getting some cash flow in the middle. We want to get rid of it somehow. Okay. What can we do to eliminate that? So we can borrow enough money today so that the debt that we've taken on is repaid with the dividends we get. Okay, so think about it. If you borrow some amount today, okay, it's some debt amount, okay, and you have to pay it off, you'll design it in such a way so that debt matures on the date that you get your dividend. Okay, so if you borrow exactly the amount of the present value of the dividends today, and you owe back the dividend amount, you can just take whatever dividends you got from your index fund and use that money directly to pay off whatever debt you owe. Okay, so that intermediate cash flow on that day is exactly zero. Okay, because you got D as a dividend, and then you paid off D as the amount you owe for that debt that you borrowed. Okay, so if you borrow PV of D, if you borrow the present value of the dividends today, you use the dividend amount to pay off, then you've eliminated that intermediate cash flow. Okay, so whatever you borrow today is less than how much you have to put up today to buy the index fund. Okay, so let's say the price of the index fund was P. If you borrowed PV of D, that means you need PV of D less to invest today. Okay, so the total amount that you've invested that you have to put up today is P minus PV of D. Okay, because you just borrowed this money, you didn't have to put this up yourself. Okay, so the cash that you have to put up today is P minus PV of D. And this is just the direct option. Okay. Now the indirect option is you can buy futures that represent the same amount of the index fund, okay, for some amount F, okay, you could buy those futures for some amount F, and simultaneously at the same time, you could buy a T-bill that matures at that value F, okay, you could buy a T-bill that matures with the value F. What would the cost of that T-bill be then? The T-bill would cost F divided by some rate, okay, and that rate would be 1 plus R, right? I mean, R would be the rate, you divide by 1 plus R, where R is the interest rate on that bill. Okay, now once again, if both the upfront costs should be the same, regardless of whether you bought it using an indirect way or a direct way, the prices should be equal to each other. Okay, the upfront costs. So if you put in P minus PV of D for the direct way, if you put in F divided by 1 plus R today, they both should be equal. Okay, so using which law? Using the law of one price. Okay, so F divided by 1 plus R is equal to P divided by PV of D. Okay, but we care about F. Okay, so we can bring this 1 plus R over to the other side, which gives us F equals this term times 1 plus R, okay, which is 1 plus R times P minus PV of D. If you want to simplify it related to the price of the direct index fund today, you could just pull the P out and simplify it in the form of the textbook, okay, which is P times 1 plus R minus PV over D, PV of D times 1 plus R, because this PV of D times 1 plus R comes in. But we pull the P out over here, so we need to divide by P again. Okay, so it'd be P times 1 plus R minus this term, okay, PVD times 1 plus R divided by P. Okay, so that's how you value futures for a T-bill and for a stock index future.